The Institute's Griffith Insurance Education Foundation is a 501c3 nonprofit, nonpartisan, and non-advocative educational organization dedicated to the teaching and study of insurance and risk management. In keeping with our mission, the following presentation is strictly instructional in nature and does not take a position on any issues.
Hello, everyone. I'm David Russell. I'm professor of insurance and finance at California State University, Northridge. And I'm delighted to be here on behalf of the Institute's Griffith Foundation for the summer series for federal staffers. We have a lot to talk about and cover today, but your time is valuable, so I'll be efficient as we discuss how insurance is a tool for economic growth. So insurance is a very complex and extremely large industry. It covers several $1 trillion worth of GDP and assets. We will talk about some of the specific metrics later. Today, we'll talk about high-level concepts, and in later installments of our summer series, you will get to learn more about some of the detail and nuance. Some excellent resources for research and specifics are the Insurance Information Institute at III.org or III.org, and the NAIC, the National Association of Insurance Commissioners website at NAIC.org. So how does insurance promote economic growth? Without insurance, consumers and businesses face uncertainty, and under uncertainty, most economic actors pull back. They tend to restrict their activity, and because of caution, they reduce their activity. With it, the presence of insurance, people feel more comfortable about undertaking activities, buying houses, buying cars, operating cars and businesses. These tools in the insurance industry help consumers and businesses feel better, help lenders feel better about lending, and ultimately provide counterparties in any contract with protection that if their counterparty or some other party to the contract defaults or something goes wrong, insurance is there to protect them. So undergirding our economy is an insurance industry that helps enforce financial responsibilities under certain conditions. So as our economy grows, and over time it does, the insurance industry must grow to increase its capacity to take on this growing set of risks. So as the number of people in the U.S. grows, people build more houses, people buy more cars, they undertake more activities, and we face new and growing threats from climate change, cyber attacks, etc. The number of tools available to people and the financing of potential losses through insurance, that must grow as well. So without growing scale, and scale comes from both doing more business as well as sharing risk with partners outside the U.S. That we use in the form of reinsurance, which is insurance for insurance companies. Without these tools, the insurance industry would potentially be overwhelmed by the growth in our economy. But insurers are ambitious and capable, and they're growing their capacity to bear those risks. As we look at potential climate change in our economy and the volatility of weather and catastrophe occurrences, this is something that insurers must consider as they protect themselves and protect consumers. And this is something you should join us in one of our future installments in the summer series to learn more about how climate change is affecting the insurance industry, affecting consumers, and how the two can work together to protect what's important to families. So what is insurance? Insurance is a promise to pay for covered losses. Not every loss is covered, but the contract, the insurance policy that many people don't read, but most people understand that accidents are covered and certain damage is covered. For example, lawsuits, collisions, fire losses, water damage. These are common occurrences that are accidental, and insurance helps reimburse consumers and businesses for these losses. They may also, through incentives and contract terms, help consumers prevent these losses and mitigate. They have safety requirements. I once had to have my house rewired because my insurance company wouldn't insure an older house unless it had updated wiring. And so the insurance company's requirements helped make my house safer. Today, something that's very interesting is more and more insurers are providing their policyholders with mitigation devices, smart water, smart homes, things that detect leaks and prevent losses before they even happen. It's important to note that not all risks are insurable. It'd be great if everything were covered all the time, but it's not. Certain catastrophes are not covered by every insurance policy, such as earthquakes and floods. Those are covered by separate policies. And business risks, such as profitability and sales volumes or speculative activities like investing in the stock market, and illegal activities. These are examples of risks that are not insurable and are excluded by insurance coverage. So some of the important terms in the insurance language are frequency and severity. So loss frequency is how often something happens. Some people refer to this as probability or the chance of loss. And loss severity refers to how bad things are. And as climate change comes along, both loss frequency and severity are going up. Now, with smarter cars and devices on our cars that prevent accidents, loss severity is going up because these devices are more expensive to fix when there is a collision. However, loss frequency is generally going down. Loss frequency is also affected by economic activity. More cars on the road oftentimes means more loss frequency. Another term in the insurance language is peril, and this is the cause of loss. So fire or wind cause damage to our property, theft, collision. These are causes of loss or sources of loss. A hazard is something that increases the frequency or severity of loss. For example, having gasoline in my garage doesn't actually cause the loss, but if there is a fire in my garage, it will make it worse or potentially increase the likelihood of a loss. Also, human behavior is one of the most important sort of causes of loss or increasing the frequency of loss. So is it moral hazard? My dishonesty, potentially, if I'm inclined to try to get money from the insurance company, I might file a false claim or cause a loss intentionally. Or morale hazard, insurance economists refer to this as the carelessness that a policyholder might express because they're covered. I might be less careful because I'm already covered for a loss. So insurance is not the only way to manage risk. And there are many different tools in the risk management toolbox. There are ways to finance losses, and insurance is one of those. And there are risk control methods. We've talked about some of them, smart home devices or mitigation techniques. My house here in California is bolted to the foundation. It does not prevent earthquakes or earthquake losses, but it may make the loss less. It may reduce the frequency or even severity of loss because my house might be able to withstand a loss. And another pitch for a future session on risk management during our summer series, you'll learn more about other tools in the risk management toolbox. So it's important to note that insurance as a regulated technique is regulated at the state level. And this is the result of federal legislation in 1945, the McCarran-Ferguson Act, which delegated regulation to the states after the Supreme Court reserved that to Congress. Congress turned around and handed it right back to the states. And the states use a interstate mechanism called the National Association of Insurance Commissioners, based in Kansas City, where all the insurance commissioners from the 50 states get together to come up with a uniform way of regulating insurance in those 50 states. That does not mean that all 50 states have the same regulations. However, the National Association of Insurance Commissioners do provide guidance when smaller states or even larger states don't have the staff or inclination to invent their own regulations, but rather depend on the NAIC to recommend model laws and model acts to implement. There are, however, federal insurance programs. I mentioned earlier that flood insurance is a separate product that you must buy. Your homeowner's insurance does not cover flood. So FEMA operates the National Flood Insurance Program, and this is a federal program that helps consumers who buy that product get coverage for flood losses. The Federal Insurance Office, which was created under Dodd-Frank, also collects data. It doesn't have a large mandate yet, and maybe never will, but it does exist, and it's a valuable source of information. And finally, TRIA, the Terrorism Risk and Insurance Act, which was passed after the 9/11 attacks, was there to serve as a backstop for insurance companies who were reluctant to insure for terrorism risk in the midst of that environment. So what are insurance regulators trying to do? Insurance regulators want to protect consumers and policyholders. That's their main mandate. One of the ways they do that is to make sure that the insurance companies are solvent and able to meet their obligations under stress. And they also, among other things, are there to prevent destructive competition. If left to their own devices, here in the United States, the insurance business is very competitive, and many insurance companies in pursuit of market share might cut rates to a place that was not profitable for them. And in the end, those companies would not have collected enough premium to cover all the claims that come in down the road. And so insurance regulators want to make sure that destructive competition does not lead to sort of a race to the bottom in which consumers are not protected by companies that can't pay. So among other functions that we've just discussed, regulators will standardize insurance policies. Some states use a state form. So in Texas, auto insurance is kind of the same for all companies. Other states read all the fine print that most consumers do not and make sure that it's clear and reasonable, and it's oftentimes tested in court. They also look at market conduct, which is how insurance companies behave in the market. How do they sell? How do they sort of approve and disapprove or non-renew consumers? I read something this morning about how one state is chastising an insurance company for non-renewing consumers in that particular state. So there's looks like a brewing squabble in that state over whether or not an insurance company can leave or non-renew, not cancel, but at the time of renewal, not provide insurance any longer. So there are lots of trade practices that insurance companies engage in, and those are overseen by insurance regulators. They also want to be sure that insurance is available in their state, because if it's not available, then commerce in that state, whether it be in automobile insurance or homeowners insurance or some sort of business line of insurance, then if that's not available, then consumers have a real problem. Here in California, several insurance companies have decided not to offer insurance to new applicants. So the insurance commissioner has a real conundrum about how to address that. And one of the reasons is, at least according to the insurance companies, the commissioner is suppressing rates, not allowing them to charge enough, and that it's too cheap, and therefore they can't make money, and therefore they don't want to enter into any new insurance contracts. So availability can be complicated when you also look at whether or not coverage is affordable for consumers. So balancing availability and affordability is something that can be very complicated in lines of insurance that affect many of us, like auto insurance and homeowners insurance. And I would encourage you again to enjoy one of our upcoming webinars, what we call Regs and Legs, which is regulation and legislation about insurance, something that governs how insurance is conducted in a particular state and potentially nationally. So we just talked about pricing, and insurance pricing can be quite complicated because it is an effort to forecast what losses will be in the coming year. So we know about the past, and we have an estimate of what inflation or what's trending in our economy or in a particular type of insurance, but we are still making forecasts with potential error. So we charge something, it may be a rate that we're allowed to charge, whatever the market will bear. And other states, they regulate rates, so we have to ask for permission in case our increase is large. Here in California, if you want to raise rates by more than 7%, you have to go through a long process. In other states, it works differently. So one of the things that you will need to know about your own state is how it manages insurance pricing. But we all care about how much we pay for insurance. Your constituents certainly care about insurance pricing. But oftentimes the law does not allow commissioners or regulators to disallow a rate increase. And that's because the market will drive that. And ultimately, if an insurance company is not satisfied with its rate and can't earn a return on its capital, it may simply exit the market or withdraw. And we're seeing that in certain parts of the U.S. now. So insurance pricing can be very controversial because of affordability and its effect on availability. One of the things that we wanted to talk about in this particular installment of the summer series is economic growth in the insurance industry within that context. And the insurance industry, as I mentioned at the top of this webinar, is big business. So it protects so many different things and so many different aspects to families and businesses, aspects and factors like property, so the things that we own, liability when we're held responsible for damage or negligence, our lives. Many of us have families that depend on our incomes and our well-being. And if we pass away in an untimely way, then our family needs financial support, and life insurance does that. Obviously, many of us visit the doctor for both routine and non-routine reasons, and health risks are something that can be staggeringly expensive, and health insurance protects us against that. Not listed here, but I mentioned later, is other risks such as retirement. And so how long are we going to need income in retirement? Social Security helps, but Social Security was never meant to be our entire retirement. So we will buy annuity products from life insurance companies here in the U.S. So as I mentioned, it's big business. About 2.9 million people in 2022 were employed in this industry, and that's up from 2.4 million. For many years, everyone thought the internet was going to take away a lot of jobs in the insurance industry. It hasn't happened. Quite the contrary. The insurance industry continues to grow because the number of risks and needs in our economy grow. So the total premiums paid for all insurance are approximately $3 trillion, and that's a very large number. There is a component of that that's an investment in annuities and life insurance, but much of that money comes in and goes right back out the door in settling collisions, fire losses, lawsuits, and of course our health claims. The net worth of the insurance industry, which we call surplus, is about $1.7 trillion. And this stands as a backstop for unexpected losses that may occur. So premiums cover the expected losses and expenses, but sometimes, as we will see shortly, sometimes losses exceed our expectation, and we need money to backstop that. The term reserve has a different meaning in insurance. It's for expected losses. Surplus is there to cover the unexpected. So investments, because insurance companies hold assets awaiting claims payment, is approximately $6 trillion across all insurance companies. So the insurance industry is sort of segmented into two different larger pieces. One of them is the property and casualty insurance industry. This covers our autos, our homes, and business liability. And according to the NAIC, premiums for this segment last year were about $750 billion. And property casualty insurers, for many reasons, had a kind of a rotten year. They paid out 102.5 cents out of every premium dollar they received. So they lost money from insurance. They didn't lose money in general because they did have investment income from some sources. But again, 2022 was a difficult year in the stock market. So property casualty insurers did lose money last year. And the reason for this is both climate volatility and claims, as well as inflation. So much of the literature talks about that claims payments and lumber costs and labor costs, all of these things went up much more than expected. And as insurers try to raise rates to cover this, they're chasing a moving target. This makes pricing insurance complicated, especially when your customers are getting these rate increases and it doesn't make them very happy. The other side of the industry is what we call life and health. And the life and health insurance industry represents covering a premature death, covering medical risk, and then covering, as I mentioned earlier, annuities, which cover the potential that we outlive our assets. So if I buy an annuity, I collect that as long as I live, and so I can never outlive it, even if I live to 110. And according to the National Association of Insurance Commissioners, this industry, because of the health business, exceeded $2.2 trillion in premiums. So as I mentioned earlier, insurance really is a large business and something that pretty much everyone in the U.S. depends upon. And the results for the health insurance business, even though COVID is sort of diminished in importance, it's still there. And COVID claims for life and for health are sort of returning to pre-COVID levels, but it's still a lingering effect. And as I mentioned, some of that $2.2 trillion isn't necessarily for losses. Life insurance and annuity contracts have investment features. So you can consider some of that 2.2 trillion as sort of money socked away as an investment for the future. So what are all of the different lines of insurance? I just mentioned two major classifications, property casualty and then life and health. But let's walk through some of the detail. So in personal lines, that is insurance for consumers, for most of us, if we drive a car, we don't use public transit, or we don't have a driver's license, we might be exempt from this. But most of us that drive a car will have automobile insurance, of course, required as part of either a lender's requirement or the government requires that we demonstrate financial responsibility for accidents. Homeowners insurance is required by lenders. It's not required by the government, but most of us would probably, even if our house were paid off, we'd want to have it covered because it's oftentimes our largest financial asset. There's also life insurance, health insurance, dental insurance, vision insurance. There are many others, including umbrella, which is what some people call excess liability insurance to protect us in case a really horrific claim exceeds the policy limits of our automobile policy or our boat policy, one of these. So if we're not an individual consumer and we're operating a business, there is a set of insurance contracts available to us through commercial lines. One of the most common is commercial multiple peril. This is a package of both property and liability. Many small businesses have a CMP policy, sometimes called a business owner's policy. Others have packages, larger businesses have packages that cover property liability, general liability, which covers premises and completed operations. If you're a body shop and someone gets hurt from your work, or someone's passing by and a piece of metal flies out and hurts them, that would be covered. Workers' compensation insures against injuries for our employees. There's professional liability such as medical malpractice or errors and omissions. There's commercial auto, which is trucking. There's business income in case our business is closed down because of a fire or other covered loss. It protects our expenses and profits from that. There's marine insurance, which doesn't cover our service members, but rather it covers goods in transit. That's what marine refers to. And there's many others. So some lesser known products, I mentioned annuities because it protects against, I used to say living too long, but it's really outliving your assets. This is a very large market because people are sort of gathering assets for retirement. Cyber liability is a growing line of insurance for hacking and other data-oriented losses where we're held responsible. Title insurance, if you've ever been involved in a real estate transaction, you're usually required to buy title insurance protecting the lender. There are other sort of lesser-known products such as difference in conditions, which covers sort of gaps or things that are excluded in the standard policy. And then there's other products which you may know about through either you or your parents. Long-term care covers the costs, or at least some of the costs, from being unable to care for yourself. So nursing home or home health coverage. There are also niche products that are growing, in some cases quite rapidly. Pet insurance is a growing area as people make bigger commitments to their pets and are willing to spend more money at the vet to preserve the health of their pet. Pet insurance has grown rapidly. And longevity insurance is something I saw in the newspaper over the weekend. This protects against if you reach a certain age, it kicks in. So this is insurance for if you reach age 85, it starts paying. Then it's sort of like a deferred annuity. So how do insurance companies operate? Well, they're in business to make money. And so how do they make money? Well, they hope that the premiums will cover all of the losses and expenses they incur, along with a small profit. And they do that by taking in money and then usually investing most of those dollars and earning a small return on that while they await claims and claims payments and claims adjudication. So they both have premium revenue and they have investment income. Now, insurance companies generally have fairly low profit margins. They don't make a lot of money per dollar of premium, but they sort of make it up on volume. And because we have extremely competitive insurance markets here in the U.S., that's good for consumers, but it makes it difficult for insurance companies to make large returns. And it exposes them potentially to losses in the event that either claims or investment returns turn out worse than expected. So I mentioned that insurance companies invest their money. What do they put their money in? Well, you may know Warren Buffett is perhaps the most famous insurance investor. He uses money from Geico and some other of his insurance enterprises to make long-term investments in other businesses. So there's obviously insurance companies need liquidity, so they hold cash assets. They also, for regulatory reasons, buy a lot of bonds. They buy some amount of stocks, and then they have other assets such as real estate or mortgages. Again, all of these investments, while some are available for sale immediately, are generally long term, so that insurance companies contribute to the long term growth of our capital stock, investing in machines and buildings. And they tend to be a fairly sticky or long term investor, which helps support economic growth. Now, regulators don't allow them to invest in whatever they want to. They do keep an eye on insurance company investments to make sure they don't load up on something and get into trouble. So there are different types of insurance markets. There's the admitted insurance market, and then there's what's called the excess and surplus lines or non-admitted market. So the admitted market is regulated by the state regulators. Rates may be regulated, but the non-admitted market is sort of where policyholders who can't get insurance in the regulated market go. So if you start a new zip lining company, or if you start a new trucking company, usually you'll have difficulty getting insurance in the regular market. So you can approach an insurance broker who go to the non-admitted market, and companies that are willing to take a little more risk in exchange for a higher premium. So this is a market that has grown in recent years as the perceived risk in the admitted markets isn't meeting the premium. So more and more insurance companies are really don't want to insure at the regulated rate. So this is one of the conflicts that we're currently seeing in the regulatory environment. So how do people buy insurance? Of course, we all think about going online through a direct channel, but most people still go through either an exclusive agent, which represents one company, or an independent agent, which is able to shop amongst several companies. There's also an insurance broker who represents the insurance buyer rather than the seller. So there are other companies that use multiple channels that we call omni-channel. One or more of these channels is the way that buyers are able to access the sellers or risk takers of insurance. Now, when you want insurance, you offer yourself as a risk. You apply, and your application is evaluated through a process called underwriting. And underwriting nowadays is oftentimes done by algorithm for simple risks like automobile insurance. For more complex risks like a large building or a new business or an existing business that's growing or acquiring another one, there will be human judgment involved, looking at all of the dimensions of risk and different aspects of loss history and forecasting whether or not the insurance company wants to commit its capital against the premium it will receive. So the underwriting process for insurance is very similar to what you might think about when you apply for a loan, whether or not the bank wants to take a chance on you at a given interest rate. Not all underwriting categories or criteria are available in all states. For example, here in California, your credit score or insurance score that looks at your credit history is not allowed, but most states allow that because it seems to be a good indicator of future claims. But not everybody agrees on the effectiveness or the fairness of certain underwriting criteria. So a couple of other insurance factoids, if you will. AM Best is an insurance rating agency that gives letter grades to an insurance company's financial strength. So you want to be sure that your insurance company is able to pay when there is a stressful series of losses. One or two losses obviously doesn't affect an insurance company. They expect that. But sort of a wave of claims can place an insurance company under stress, and AM Best conducts a number of stress tests that sort of evaluate insurance companies' financial strength. There's also something called reinsurance. As I mentioned earlier in this presentation, reinsurance is a way for insurance companies to take on risk and then pass some of that on to another insurance company so that under significant claims activity, they're able to smooth things out and bear risk a little more effectively. One of the tools available to an insurance company is a catastrophe model that says, well, what if we have a terrible wildfire? What if there are a series of windstorms or a hurricane? What will be the potential loss from that? So catastrophe models are technology tools available to insurance companies to evaluate whether or not an insurance company is able to withstand risk and certain claims scenarios. And as you may know, the Federal Reserve has been raising interest rates, and that has certain good and not so good effects on insurance companies. It does increase the return on newly invested dollars. However, it's going to tend to slow down economic growth, which may decrease the demand for insurance. There are a number of other factors as well, but interest rates are something that insurance companies definitely care about. So, as I mentioned earlier, governments, the federal government is involved in flood insurance and terrorism insurance. In state insurance, there's something called a FAIR Plan, and a FAIR Plan is an insurance mechanism in any given state to make sure that insurance is available and affordable to residents who might not otherwise get it because the private market simply isn't there. The states also guarantee claims for certain types of insurance like auto or homeowners or liability or life insurance in the event that their insurance company becomes insolvent. You can think of it similar to the Federal Deposit Insurance Corporation, the FDIC for insurance companies. However, it's not the same and it's not federal. It's conducted on a state-by-state basis. Certain states have catastrophe facilities. Here in California, we have the California Earthquake Authority that protects, if you buy the policy, it protects residents against earthquake risk. And in Florida and other states, you have Citizens and beach and wind pools that protect coastal residents against that risk of hurricanes usually. Also, in other states, you have state workers' compensation plans that provide a mechanism for certain types of businesses to get workers' compensation insurance. A couple of current issues that I've mentioned, claims volatility and inflation have caused rate increases and availability and affordability debates at the regulatory level and at the corporate level. Some insurers are pulling back or pulling out of certain states because they feel that the regulatory environment is hostile and not worth it. But that may create an opportunity for other insurers to step in, or may create the need for a state mechanism as a relief valve. All of these things create stress in the economy for how, will I be able to buy a house if I can't get homeowners insurance in that area? Another dimension that will be mentioned in a future seminar is AI, and whether or not AI represents a threat or an opportunity or both for the insurance industry. AI can certainly help insurance companies reduce their cost, but it may change how insurance takes place and may challenge insurance companies. So in summary, it's been my pleasure to share with you the fact that insurance is critical to the function of our economy and critical to growth. Insurance has grown in response to economic growth. Without insurance, most financing activity and credit activity wouldn't take place. This is critical to buying large capital goods and homes in our economy. New drugs and new products wouldn't be available without insurance. So families and businesses who didn't have insurance would have to carry larger amounts of working capital. That would not be efficient. So insurance allows economic growth to occur in an increasingly complex and growing economy. I want to thank you for your public service and your attention today. And again, I encourage you to attend future seminars and webinars in our summer series. Thanks, everyone.